I'm the founder of Champamerica, a New York City-based career coaching and workforce development company. Our goal is to help our students and career seekers to understand the real industry. How we do this is we often invite industry professionals to join us, and we hold these intimate discussions for you to explore what they do, and through that process, find out more information about the industry. And today we have our guest speaker. Let's go here. Our guest speaker is Karthik. Given that I have a bad voice, Karthik, you mind just give yourself a quick introduction?
Sure. Hi, everyone, and thanks again, Heather. Happy to be here and happy that you guys joined. So my name is Karthik Shanmugam, and I am let me start off with my background. I'm a computer scientist and mathematician at heart. So for anyone out there who is, all right. So I started my educational background at Emory University, where I got a computer science and math degree. Then I went over to Columbia to do some post-grad research within visual recognition and facial recognition. And then from there, I went to NYU, where I got my master's in computer science and financial math. From there, I started my career in finance, working at pretty large banks, be it Citi or JP Morgan, as well as Deutsche Bank. And then I started working in different areas to really focus on a skill that I really love and a career I really love, which is product management. And I worked at the New York Stock Exchange, Morgan Stanley, and currently where I am is Tower Research Capital, which is a high frequency algorithmic trading firm.
All right, so just going to go back and talk about our agenda today. We're going to talk about what electronic trading / high frequency trading is. Talk about industry, who are the major players and what they do. An important factor to mention is the cybersecurity in the age of electronic trading. And lastly, we'll talk about the career path for those who might be interested in electronic trading and the skill sets that you need to develop in order to get into the field. So without further ado, let's go into.
Great. So how would I start this off? Well, electronic trading has been going on for a while, and really simply electronic trading is the ability to put in orders and execute in electronic fashion, which has been going on for a long time. But I would say that what's really important is, just to give you a historical background, is that the rise of the machines really started about 40 years ago. And before, the type of trading was this framework called open outcry, which some might be really familiar with, where people are within a large pit and yelling back and forth. And that type of trading has gone on for hundreds of years. But what really started happening is that within the 70s, with the increases in technology, and what specifically I mean is the areas of being able to communicate with people farther, which means the increase in telecom and the ability of computers actually to store data. That really started within the 70s. And then really one of the major areas was in NASDAQ, which is forming something called a matching engine. And what a matching engine really is that previously with the open outcries that someone would say, I want to buy, I want to sell, and they would say match. Here in an electronic environment, it would be the same thing, but the machine does the matching.
So in the past, human actually was sitting at the middle to do the matching.
Exactly. The humans were there to actually make the match.
So the broker.
Yeah, so previously it would be that the brokers would meet with another broker, then they would have a runner who would actually go down and say, here, we need to do settlements, and then an accounting person would write this down on the book, and then someone would go and actually send out the settlement mail, which sounds pretty arduous and just inefficient, right? But that was what it was then. And then really we saw this continue ongoing increase within the 80s, where computers really started getting built. And if not to go too much into the technical aspects, but once we started getting silicon chips, being able to actually make processors and computers that are very small, we started seeing this happen more and more. And even in the information age, even getting more information, this happened in the 80s. And there was a man who actually started at Salomon Brothers around the 80s and said, hey, why don't I put all this information on a computer screen? At the time, the people at his firm didn't like him, so he got fired. So he said, you know what, let me open up my own shop. And his name is Michael Bloomberg. So that's how all these things kind of started. And then in the 90s, when you see the increase in technology, specifically, I would say cellular networks, that really increase the idea of we don't need to have as many broker specialists within all these exchanges, and that model kind of eroded. And then when we see into the 2000s is the huge proliferation, all of these things started coming together. And really one area that was really fascinating is that I actually listed here in the, an area is the Cold War, ending in the 90s really started proliferating it. Because if you think about it, during the 90s when the Cold War ended, you had a lot of scientists who would build missiles and said, I'm out of work, what should I do? And it's really the truth is that if you look at it, a lot of these scientists said, well, I have skills such as I know how to model continuous pricing or continuous flows of rocket propulsion. So they would say, I can use this in finance. And that's why you saw the age of electronic derivative securities pricing and the ability of looking at networks and saying, how can we find the shortest paths? And that's how you started seeing a lot more mathematicians and scientists come into finance.
Wow, that's an interesting bit of history.
Yeah, and then in the 2000s, you continue seeing this, and really, that's when the age of algorithmic or high frequency trading really took off. And especially after the 2008 financial crisis is when high frequency trading really took off. And the reason why I say the 2008 financial crisis is that once regulation happened, and some of you might be familiar with something called Dodd-Frank, is that a lot of these areas of derivatives, previously people would love derivatives because they were something called over the counter and they were opaque and you could make a lot of money where we call it the spread was really high. No one could see it. But because of the regulation, everyone wanted all of these type of trades to go on exchanges or swap execution facilities, and those spreads became razor thin. So what people saw was, how can we move to markets where we could take advantage of our technology? And really that's where high frequency trading took even further. And people who were not in the niche area of high frequency trading started using it. And that's why you saw big banks started saying, we need to hire these people to come in and work for us. And that's why you see a huge electronification of those. And now in the 2010s, I would say the largest area that's been really coming up is the continued research that has gone into telecom. And I'll explain a little bit further about how that's very important. But also what's key is what we like to call is distributed computing. And you all might be familiar about it as clouds, is the ability of looking of large data sets and not really bogging down your systems to be able to analyze the data very quickly. And that is very helpful in the age of electronic trading, especially high frequency trading. So moving on, one area that you all might be asking is, so what is high frequency trading? Is it just something where people trade really, really fast? And the short answer is yes. Really what high frequency trading is that it means a lot of different things to a lot of different people. And what we truly say is that there's an area called a latency profile. And what we say by latency is how slow you are. But what really high frequency trading is that we really focus on finding the inefficiencies in markets and making them less inefficient, but more importantly, doing this at tremendous speeds. And what we really want to highlight here is that I like to usually use this example with some of my friends too, because they look at me and they're like, what is high frequency trading? They say, I'm on my E-Trade account and I can trade pretty fast, but there's a much different speed here. So when we look at something where if you're on your brokerage account and you say, hey, I want to make a trade, and you see it and it's immediately filled or executed, it takes about a few milliseconds. but that to us is tremendously slow. A lot of the other places where some people look at a mid to low frequency, and that's gone even further down, which is microseconds. So if we look 10 years ago, someone who was trading microseconds, and what we say is back to back, which means you put in an order and you execute it, and it comes back in 100 microseconds, that would be great. But within 2014, that became way too slow. And then now high frequency, some people do it in sub microseconds, which is 5 microseconds. But then we have ultra low latency, which is even faster. And those are within the nanoseconds. And what's really happened, and I think what's really important, is that the trading has become so, or the technology has become so important that people will look at, how do I put my code not just on a server? They look at it, how do I put my code on the actual processor of the server? Or if you guys aren't familiar with network ports or network switches, is this ability of, if you look at your cable router, the back of it is a network port. What some people do is they say, I have the ability to actually put that on the network switch. So we're talking extremely fast speeds. And that's why it's really interesting when we brought up people like from the Cold War, because a lot of some of the skill sets that we'll talk about later is that for those people in those really niche markets, they really say, we need people who know electrical engineering, or people who've worked on missile systems or aero defense, because they understand speed, and that game is as important, and those skills translate to those.
So given what you mentioned earlier, high frequency trading is really driven by the improvement in technology, right, where you can trade at much faster speed, and also sort of driven by the fact that the margin has become very thin. So large trading at very high speed will help kind of make up for the lower profitability.
That's correct, Heather. So yeah, the age of high spreads, large spreads, they're not around as much anymore. And that's really one of the areas where that's where the proponents of high frequency trading bring up, and some of the naysayers bring up as well. So, and actually that's a good segue to this area, is that people think, well, this is a very specialized environment, and overall, is it fair for the whole market system? Does it help mom and pops actually succeed in this? And so, some of the advocates, me being one of them, I believe that the electronic trading, or specifically high frequency trading, removes some of those inefficiencies and really does allow some of the smaller players to actually make a profit and actually beat some of these larger institutions. So you'll have trading teams that have 2 people and are working in a WeWork area, and they're able to do this. And it's really incredible, right? And I think what's really important is that it actually provides a lot of growth in other countries. So one of the most important things, at least personally, that I think that the United States has, that most countries agree with, is that the United States has the largest capital market system and the largest exchange system. And that has driven tremendous growth of capitalism within the United States for the last 60 years. And some developing countries haven't had that access. But now that they do have exchanges, high frequency traders love to trade everywhere. And this actually does help the growth of these countries. But some critics will say that the fundamentals of the markets are frayed because of high frequency traders. So they will see movements where a particular company in an equities market has a really good quarter or a really good year, but their stock goes down and people don't understand why. And also another thing is that they think, since of the specialization of technology within this area, is that they don't have that edge. And one important aspect is, and if some of you are familiar with the book Flash Crash, this brings it up, is that since we have that loss of human interaction, it could become very dangerous, some may say, to cause markets to have huge volatility or come crashing down. Where I would say, I think if you have good risk systems and you put a lot of research and development in that, that can be alleviated very quickly. And I think a lot of the larger players in this field, not only high frequency trading shops, hedge funds, or even banks, spend a tremendous amount of resources on that.
Right. And I think for a lot of people that follow the financial markets, I would say the past 10, 15 years, you start to realize there's more and more large volatility days, right? Would you say those are largely attributed to electronic trading? A lot of the algorithm kind of driving market one way or the other?
Right, so that's a good question, and that really depends on, as we bring up, is the microstructure. And really when we mean microstructure is really the like what we like to say is the liquidity of the market. And for some of you who aren't familiar, just think of when we're talking about liquidity in markets, these are terms that people who have been in the industry for a long time know about, but I like using it. The best way of thinking about it is thinking of a casino. When there's a lot of people playing in the casino, there's a lot of liquidity, right? And there's not a lot of people playing, there's not as much. So the way to answer your question, Heather, is that it really, sometimes it depends on the strategy. And sometimes we'll have macroeconomic events that will cause huge shifts in volatility, and that's where high frequency trading or traders will take advantage of it.
Which exasperates sometimes as well, right?
Yeah, exactly.
Good example.
Yeah, thank you. So if we wanted to continue with this, I think being in this field, at least with electronic trading for all my career, but specifically in the high frequency trading world for about 3 years, I would say some of the trends that we really see is this idea, I think in all of, not to get on my soapbox about all of the world, but cybersecurity is a tremendously important part within high frequency trading. A lot of people find the most important thing within this world is our intellectual property, which is a tremendous amount. Let's be blunt here, is that our code is king. And we always have to make sure that our client strategies, meaning our trading teams, strategies are secure, they're safe. And what's more important is that there's a lot of people out there that what we say is listen to how people are trading. And meaning is that when you're in an electronic world, you can actually map out the market, or as we like to call it, the order book, and you can see how people are trading. But there's other ways that people can come in and try and understand other one's code, other one's trading strategies. So it's one of the most important areas that I see and that a lot of firms see. And then another area is, I like to call it regulatory arbitrage. So the ability for trading firms to see opportunities within upcoming regulations is paramount. As some of you are watching the webinar might know, is that a lot of people within the financial services world sometimes scream about regulations. They think, well, we're gonna lose money. And really, I think in the high frequency trading world, we consider those people dinosaurs because they are really just holding on to something that's gone. And in our world, we know that change is inevitable. A lot of our algorithms, a lot of the people in this space really read stuff such as like genes and genetic mutations and all of this stuff, because to understand markets is they're never the same. They always change, they always mutate, and so does regulations. And it's a zero-sum game sometimes. There is a place where you can find where regulations help specific trading strategies and things like that. And that's what we, and not only we, but everyone in the industry sometimes looks for. And I think one area that I find fascinating, and I think a lot of us do, is that since we do have this ability now to gather so much information and put it on large data stores and clouds and everything like this, is that now we are able to find more insights in this information. And the reason why I wanted to put up Thesos and things like this is that people now are starting to use even more information, such as satellite information. If you guys aren't familiar, is that what happens? I'll give you a perfect example. So everyone knows Tesla, right? And everyone looks at how Tesla is going to do and how they're going to need a quarter of how much deliveries. But there are some people who gather satellite images of Tesla trucks and see how many trucks are leaving the plant. And what happens is that they take satellite images and they make them into numeric values that can feed these algorithms. So what's happening is that there's multiple things, not only that, but looking at shopping mall information, or that they call rights, but there's also information where people started looking at machine readable news. So what happens is that they have something called scrapers that look on multiple sites. And with the advent, like the increases of things such as natural language processing, you're able to quantify these things, feed your algorithms, and make them more aware, as I like to say, as people like
into the trading strategy.
Exactly. And that's where when people talk about artificial intelligence with machine learning, that's where it happens. So now people use machine learning to enhance machine learning and things like that. So
that's a really interesting concept.
Yeah. So
scary too. Right?
Yeah, I mean, that's why it's funny is that sometimes people, not in my current area, but I remember at Morgan Stanley or even in other banks, people would start calling their algorithms some really unique names like Terminator, things like that, because it really is, for lack of a better term, it is the rise of the machines, guys. So it is a very interesting field if you like this stuff. And then one area that I want to really highlight is a skills area. Now, it was funny is that before this, Heather and I were just chatting about this. So Heather and I both come from different backgrounds, but we, being both in the industry for quite a long time, saw these different shifts and skills that are happening. And previously, there was in the 80s and 90s this idea of a salesperson as well as a trader, and they having these specific skills. So when I started my career in the early 2000s, a lot of the times anyone on a trading floor would be someone who has specific MBAs or from Wharton or wherever, or an accounting degree or an econ degree, things of that nature. And really what happened, I remember when I was a trading floor, I was like, oh, okay, I'm the IT guy. And they would want me to, but what I would see is that they would need me much more. It was pretty surreal. And I would say during the financial crisis, I saw that even more so, where before they would have people booking manual trades that were really large, but then during the financial crisis, they needed automated ways of trading this. So now what you see is that you see this idea of traders basically having a mathematics degree or a computer science degree or a physics degree or any hard technical degree. And for people who are econ, if you've taken an econometrics class, great for you, because it's a really important area. And I believe what's funny is that I recall when I started that we would have to build, some people would have to have the amazing PowerPoint skills and things of that nature. But now I think with the oncoming areas of dynamic dashboards and things like that, areas such as like a Tableau or other different types of visual tools are really becoming paramount. I believe that what you'll see in the next 5 years is that presentations that we're showing you guys right now will be gone, and we'll just probably showing you Tableau dashboards the whole time, right? So I think one area that would probably be really important in this is that while this has been very centered around technology, there's a reason why, and it's because I'm a technologist at heart, but that is not the only area that all of these electronic trading areas need. I'm biased, so that's why I would say, oh, technology is king, right? But there is a lot of different skill sets and career paths in here as well. So within be it any type of electronic trading, there is an area that's really important of the management of how do we connect to all these multiple exchanges. And that is a huge part of where business development comes in. Not only that, traders are usually not focused on looking at these things. They're looking at, all right, this market, how much money can I make in it? But the idea is that business development areas such as being able to do project management to actually allow these teams to connect to these markets. And more importantly, there's a huge area of understanding risk controls that are, if anyone is in any electronic trading environment, they would say risk is one of the most important areas here. So I think that's a really important area to highlight, is that there's definitely multiple skills that are used in this world, or in this world, or in this sector. From a work environment area, so as you can see, I'm just wearing a sweater today. Before, in my previous job, I would have to, in the banks, I would have to wear suits, and I loved it. I thought it was nice to wear a crisp suit, but as I got a little older, I thought, hey, why don't I
make yourself comfortable, right?
Exactly. So it really depends on the area. I mean, in my place, you'll see people wearing shorts and flip-flops. But in some areas, people dress up. So, but that's just the clothes. But the work environments vary from place to place. Every place has a different culture. And it's really important to ask about that. I think what's really important, though, is that a lot of these places can give you like free breakfast, free lunch, parties, whatever. That doesn't mean culture. That's just collateral, right? Just to be really clear, is that that's not, sometimes I've spoken with colleagues in other areas and they say that happens and they think it's like a facade. That's something to be mindful of, is that those things are perks. You really want to make sure, how do you work really well, and what, say, right fit for you from a personality point, and also what is it's always important is to understand what is the strategy of the firm. Right? I think that's really important. And from a career trajectory and financial consideration. So this is always kind of a key. So from a career trajectory, at least from the electronic trading world, we have multiple, if you think about who does electronic trading? So you have retail people like the Ameritrades or the E-Trades of the world. You have institutional trading from a sell side, and sell sides are usually considered broker dealers, large investment banks. And then you have some areas which are called buy sides, and buy sides are usually large asset managers, which take in outside money. And then you have some other areas which are called proprietary trading, or family offices who take they just use their own money. In those areas, career trajectories are very different. So usually in buy sides and proprietary sides is that you could hit a particular plateau in some areas. They're usually focused on, all right, well, they're smaller, so you can do a lot of things, right? Titles aren't very big in these areas. And from a financial consideration, it really depends year to year. Usually
performance driven.
It's very performance driven. And I would say this, if buy sides are heavily based on bonus. So you will reach a plateau on a salary, and that's usually due to tax considerations. So you'll have, and there'll be CTOs who are not even CTOs, like heads of firms, right? And they'll have salaries that max out at like 200K. But the thing is that their bonuses are 7 or 8 figures. That's a different story. Now the banks are a little different. They will have some big increases in salary, but again, the bonuses won't be as large. But there is a lot of room to grow in there as well. And I would think that you can definitely switch through all of these different realms. I've never been on the retail side, but I've always been an institutional person and moved into the buy side. So there is movement. They do really focus on your different skill sets. It's not, titles is not that large, especially in this industry.
So just a question, do you find moving from sell side to buy side to be the trend for people in your field? Or, do you find people going directly into buy side when they graduate school?
So it, it's interesting is that I would say this is that usually the pervasive theme has always been that sell side people want to go to the buy side. And that is a challenge and it's very tough. I will admit it is a very big challenge. I would say buy side going to sell side, that happens quite a bit. And straight from college, it really depends on where you're going. We do see people come in from straight into the buy side, from coming straight out of graduate school or undergraduate school. It can happen in both. It's really driven on the demand they're looking for. And at least from a buy side, it's definitely about the demand they're looking for. And it's really about skills. And they will, during the interview process, will, for lack of a better term, grill you pretty well.
I'm sure they won't make it easy.
Yeah, but also banks have tremendous reputations and they definitely are very selective. So that happens as well over there. Right. And then one area, just to speak about this, I think this is a good segue about what we're talking about now. So from an education background, I would say, at least in my field, so I work within our core engineering area. So in our world, you have to be very technical. And so having specific programming skills, because they will give you a programming test, having a mathematical background, because they will ask you to do a particular mathematical exercise. So I have a financial math background. Heather is a CFA. So one of the things that happened, at least for some of my interviews, was they would say, hey, can you do a modification of a Black-Scholes pricing model? That happens, right? And usually if you get it wrong, they're not going to get too mad, but they want to see how you think about things. From a coding world, they want to see how good your skill set is. That's just paramount. But as we were talking about, there is other multiple areas within electronic trading and understanding how you think about a problem is very important. So when skill sets, so if people are able to logically explain their thoughts about how would they go and handle a specific problem, or if you've worked on large projects that require an extensive amount of coordination, they're going to talk to you about that. They're going to want to know, all right, well, can you speak to me about a specific project you did? How did you coordinate this? How did you put timelines in? How did you prioritize different things? And also, how did you put any contingencies in place for things going wrong? They really focus on how thoughtful you are about these things, because in our world, this happens quite a bit. Right, and from a pure education background, any technical aspect is good, any math, computer science, things like that. But I know some of the best people that I've worked with have had English degrees and have been some of the best coders I've ever seen. So anyone who has different types of degrees are very interested. And one area I will bring up is if anyone has a psychology degree, right? Usually when I think of people who have psychology degrees, usually I've heard a lot of them go to law school. What I've seen though, is that there is I'm one of the fanboys of it. There's an area called psychometrics, and it's the ability to understand and predict people's behavior. And we use that at some of my previous areas to influence trading behavior. And I would say, if you're all familiar with Cambridge Analytica, they're one of the, I would say, they were one of those people who kind of brought that to light, is this ability of how to influence behavior. And that will become even more paramount, I believe, in the future as well.
Scary as it sounds.
Yeah, it is a little scary, isn't it? But yeah. And then finally, I think just some of the areas that just from my experience of being either interviewed or interviewing people. And one area that I do bring up, there have been people that I've interviewed and or spoken to who've reached out, and they said, I'd like to be a data scientist. And every time someone says that to me, I always go, oh, what do you mean? What is it? All right, that's data scientist. Can you explain to me what data science means to you? Right. And I think what will happen to all of you is, and just to be blunt, and I think it's probably important, is that when we're speaking to people about data science and someone's saying data science, it comes off at its worst, it comes off as a little disingenuous, because it's just so high level. Because I think I was speaking with Heather previously, is that one of the things that data has been around for years. It's been around for almost 100 years since Alan Turing was building those machines to try and beat the Nazis. So all of this has been around. So people want to understand, what do you mean by data science? And specifically, when I think of data scientists, I personally think it's, all right, well, you like working with large data sets. So what do you mean? What do you like doing with large data sets? Do you like normalizing the data? Do you like running specific mathematical models to find insights, such as different types of linear regression? Also, some people like visual areas, some people don't like visual areas. And so what will happen is that some people will go, all right, well, how did you take a large data set, normalize it, run some specific models, and how do you show value? So how do you have like a front end view about it? They really will want to understand, when we say science, is that when I think of a scientist, is that you think of a hypothesis and then you try and prove your hypothesis, but you also have what is your foundation or your stable constant within that. And people will ask you about that, especially in our world, is that they're going to ask you about all of those things. So if we say something is data science, I really do think it's a trap question.
Right.
If you bring it up. So just be really mindful of that.
And be specific where you can.
Yes, people in this world are, and I learned this sometimes the hard way, is they don't like high level. They want specific details. So it'll be really important. And similarly, some of the interview questions that we spoke about was this idea of, if you have a large project, can you go through all of the specific details about it? Specifically, what did you do to organize it? Do you like to initially plan? Do you also understand risks that come up during the project, and how do you overcome it? Within this world, there's a tremendous amount of coordination needed, and the ability to be a bridge maker is very valuable. So for people who are saying that I don't really like to be technical, I like social interaction, I like meeting people, trying to get people together for one purpose, there's a definite need for you here, right? And finally, if you're a developer, know your data structures, know your code, understand garbage collection in the different types of coding, because in this world, Python's great, but in some of our competitors and all of this is that we'll take a compiler and recode it to our spec. So we go all the way down to the machine. So you just have to be on point with that.
Let me see if there's any question. Yep, I just had one quick question while we're at the end of the presentation. You mentioned the importance of risk management. Right? Maybe give us some anecdote of risk management, from operational risk to your market risk to how you protect your physical, the codes and the intellectual properties.
Right. Yeah. So risk again is a large term, and it means multiple things. So yeah, one is operational risk, one is cyber risk, one is trading risk. And one is balance sheet risk, right? And depending on the world that you're in, those are really important. So for example, in our world, electronic trading risk is a very important thing. Making sure you don't hit a particular threshold of how much you can trade. Also making sure if you see any anomalous type of trades that seem either too large or too small or odd shaped form, when I mean odd shaped form is usually some people look at odd lots, which means like usually trading will go in orders of 10 or orders of 15, but sometimes there's like 17 or 20. There's all these different types of activities with trading that can become very suspicious. And what happens is that it doesn't only put risk of a particular trading team, but it can put risk to the whole firm. It can bring risk to the whole financial markets. Right. It's very, very, very important. And one anecdote is that some of our compliance people talk all the time is that looking at Getco and Knight Capital Group. So there was what happened is that there was some code that was released without proper testing. It put out a very large trade in the market. Then all of these other algorithms, which are basically like other robots, went and attacked it and brought it all down. And that's why you had something called, that's why what happened was in one day, the whole firm went down. That's why in all of these areas, risk management from a trading point is very important. When we look at operational risk as well, is that we look at things such as how do we look at our large data centers and how are they secure? Honestly, one of the funniest things that happen in electronic trading is that when you look at people who actually say, hey, we want you to come and trade in our colo, you actually have a data center tour. And I would joke as like, oh, is there going to be a gift shop there or something like that? And then no, of course not. But what happens is that people are very, very particular about this. So for just give you an example. So the New York Stock Exchange, their data center is within Mahwah, New Jersey. And Mahwah, New Jersey is called a tier 1 guarded data center. So what that means is that the data center has basically a moat around it. So the reason why is that so someone can't have a van full of explosives and tries to run into it. Also, the data center is lower into the ground. So if there was an earthquake or a hurricane or even a nuclear attack, they have that. And something what we also call is hot redundancy, which means if a data center goes down, there's another data center that lights up. Yeah, that immediately goes on. Because for us is that those operational risks are that if a data center goes down, we could be in the market on a position that we don't want to be in. Right. And that brings a tremendous amount of risk to us as well. So we think about that. And finally, as we were talking about previously, is that cyber risk of maintaining and keeping your intellectual property. That's I believe, I would say all around the market or all around the street.
So how do you prevent people from copying your code, for example?
Well, Sarah, we'll have to say that's secret, but there is, I think from a cybersecurity area, if anyone's interested about it, is looking at your endpoint detection, meaning how people connect to you, or we have things of boundary defense with making sure extensive firewalls, and then also monitoring. So making sure you're looking at any type of activity on any of this stuff. It's a huge part, and really it's not about the street, about Wall Street. This is anywhere, right? I would say that for big banks, they're really worried about going into jurisdictions where some places say you can't put encryption on specific information. So there are some countries that say if you are within our data center, you can't put encryption on any of your traffic that's going in. So what some people worry about is that these countries have sovereign wealth funds that are part of the government, and then they can give them the information so they can trade ahead of all these people. Right. So all of these different things are very important. So that's why sometimes when people want to trade in a particular market, they might not have, might not be in a data center or coloed within that jurisdiction.
Yeah.
So
amazing information.
Yeah, it's a unique world and a really fun world. So I hope this brought some color to it, and definitely. Hopefully some of you would find some interest in it. And if you're interested in all of these type of things, there are on my company there are opportunities open for undergraduates, graduates, things of that nature. So feel free to look out. But we do have competitors; they also do it as well. Although we think we're the best, and rightly so. And yeah, and I think all of these skills are pretty important. And so if you're all an undergraduate now, I'd really speak to your career center and see if they have this information. If not, LinkedIn is always a great area to go in. And if you are able to reach out to colleagues, people there, and actually want to say that I'm really interested in talking about electronic trading, most of these people would be happy to discuss it with you.
Perfect. Great. I definitely learned a lot from you today, and it's really good to reconnect, thinking we were working together in the mid-2000s, right around the financial crisis. So the world has changed quite a bit since that time. But amazing to just always finding out new things. And like Karthik said, I hope all of you listening today, and those of you will be checking it out on our YouTube channel, listen to it again. There's so much information I still feel like I need to unpack and digest. So thank you very much for your time. And hopefully we'll see you again soon.
All right. Thank you, guys. Take care.
Bye.